Did you know that mutual fund returns are taxable? Many investors focus on returns but overlook how taxes can impact their earnings. If you're not careful, taxes can eat into your profits. In this episode of Master Mutual Funds, a beginner's guide, we'll break down how mutual funds are taxed and, more importantly, how you can invest smartly to reduce your tax burden. Let's get started. Types of taxation on mutual funds. Number 1, equity funds taxation. Equity mutual funds primarily invest in stocks, and taxation depends on your holding period. Short-term capital gains, or STCG. If you sell your equity mutual fund units within 1 year, your gains are taxed at 20%. For example, you invest 1 lakh rupees in an equity fund, and within 6 months your investment grows to 1,20,000 rupees. Your gain is 20,000 rupees, which will be taxed at 20%, meaning you pay 4,000 rupees in tax. Long-term capital gains, or LTCG. If you sell your equity mutual fund units after 1 year, your gains up to 1 lakh rupees per year are tax-free. Any LTCG exceeding 1 lakh rupees is taxed at 12.5% without indexation. For example, you invest 5 lakh rupees, and after 2 years, your investment grows to 7 lakh rupees. Your gain is 2 lakh rupees. The first 1 lakh rupees is tax-free, and the remaining 1 lakh rupees is taxed at 12.5%, so you pay 12,500 rupees in tax. Tip: holding equity funds for more than a year helps you take advantage of the 1 lakh rupees LTCG exemption. Number 2, debt funds taxation. Debt mutual funds primarily invest in fixed income instruments like bonds, short-term capital gains, or STCG. If you sell your debt fund units within 3 years, the gain is added to your income and taxed as per your income tax slab. For example, if you fall under the 30% tax slab and make a short-term gain of 50,000 rupees, you'll pay 15,000 rupees as tax. Long-term capital gains, or LTCG. If you sell after 3 years, LTCG is taxed at 20% with indexation benefits. Indexation helps adjust your cost price for inflation, reducing your taxable gain. For example, you invest 1 lakh rupees in a debt fund, and after 4 years, it grows to 1,50,000 rupees. With indexation, the adjusted cost may become 1,20,000 rupees, so your taxable gain is 30,000 rupees. At 20% tax, you pay 6,000 rupees instead of 10,000 rupees without indexation. Tip: debt funds are more tax efficient if held for more than 3 years due to indexation benefits. ELSS, or equity-linked savings schemes, are a great way to grow wealth and save taxes. Investments in ELSS are eligible for deduction under Section 80C, up to 1.5 lakh rupees per year. ELSS funds have a mandatory 3-year lock-in, which is the shortest among all tax-saving investment options. Gains above 1 lakh rupees are taxed at 10%, just like regular equity funds. For example, if you invest 1.5 lakh rupees in an ELSS fund, you can reduce your taxable income. If you are in the 30% tax slab, you save 45,000 rupees in taxes. LSS is a great option for tax saving with high growth potential, but it's best suited for long-term investors. How to invest tax efficiently in mutual funds. Hold investments for the long term. Avoid unnecessary redemptions to benefit from lower LTCG rates and tax exemptions. Equity funds get 1 lakh rupees LTCG tax-free, and debt funds gain from indexation after 3 years. If you're already investing in mutual funds, consider ELSS for tax-free Section 80C deductions. Instead of withdrawing lump sums, use SWP or systematic withdrawal plan to withdraw money monthly. Since only gains are taxed, SWPs can be more tax efficient than selling units at once. For example, if you withdraw 30,000 rupees monthly via SWP, but only 5,000 is capital gains, tax applies only on 5,000, not the full 30,000. If you need regular income, opt for SWP in a debt fund after 3 years to get indexation benefits and lower tax liability. Understanding taxation is crucial for maximizing your mutual fund returns. Smart tax planning helps you keep more of your profits while still investing wisely. In the next episode, we'll discuss how to analyze mutual funds to help you pick the right ones. So don't forget to subscribe to Stock Glimpse India and hit the bell icon to stay updated. If you found this video helpful, hit the like button and drop a comment with your questions. I'd love to help.